Is maximizing shareholder value contrary to the interests of corporate social responsibility? It's an ongoing debate. Welcome to this INSEAD Knowledge interview, in which we're going to focus on a recent paper published by Theo Vermaelen, who is the Schroders Chaired Professor of International Finance and Asset Management at INSEAD. Theo Vermaelen, welcome.
Thank you very much. Thank you.
Your paper is called Maximizing Shareholder Value, an Ethical Responsibility, ? And I think you can answer that question. But first, why would a finance professor want to dabble in ethics today?
There's two reasons. The first reason, I think, is that the finance professors in some way have been criticized a lot by especially people on the other side, like the ethics professors, that because we teach shareholder value maximization as an objective function, that in some way we encourage even our students to unethical behavior, so that there's something unethical about maximizing shareholder value. And I think that opinion is based on lack of misunderstanding of what we actually teach in finance courses. So the first purpose of the paper is to clear up exactly what we actually teach, what we mean by shareholder value, as opposed to what is being perceived by many people in this area. And the second reason, I think, is to develop a new concept, a way of thinking about ethics that's not so associated with highly personal values and highly time-dependent values of people. And I always remember my days when I was a professor at the University of Louvain in Belgium, where there was a business ethics professor who wanted to start the Leonardo Lessius Institute of Business Ethics. And I went to the library because Leonardo Lessius was a priest that was a teacher at the University of Louvain in the 17th century, and was seen as the father of business ethics because he wrote a book, De Jure et Justitiae, about when is it ethical to lend money to charge interest, because, as you know, the Catholic Church always was approached to lending money. So, and I went to the theology library at Louvain and I got a copy of this book, and there's also a chapter then in about torturing pregnant women. Is it okay to torture pregnant women? And there he says, well, it's okay to torture women, but not when they're pregnant, because then it hurts the unborn child. So that's when I was at the faculty meeting. I said, maybe it's a bad idea to call something a business ethics center of someone that approves torture. So it shows you that the opinion about what is ethical and not is highly dependent on individuals' opinion about values and about the time, what we're talking about. And this is why I want to propose a new type of way of thinking about ethics that is different, that is less associated with individual values, and that could be shared, I think, by business people in general.
All right, well, getting to the core of your paper, when you say maximizing shareholder value may well be an ethical responsibility for CEOs, what do you mean?
Well, I think that the way I see the corporation is like a nexus of contracts between various people, between workers, the management, between the shareholders, the bondholders, and other people. And many of these contracts are governed by implicit and explicit features. For example, you work at INSEAD, the explicit feature of your contract is probably how much money you can be paid, what is the duration of your contract, your health benefits, whatever. But there's also an implicit part of your contract that if you work at INSEAD, that you don't have to pay for your own office, for your own chair, for your own computer. There's kind of implicit there. If INSEAD typically would hire people and then they have to pay for their own office furniture, that would seem like as an unethical behavior that would give INSEAD a very bad reputation and force people that work at, if people want to come to INSEAD, they will ask a higher salary to compensate them for the expected unethical behavior of INSEAD. So I think it's very important that the corporations manage carefully the implicit contracts they have with people. Or MBAs, for example, that come to INSEAD, they know explicit part of the contracts, the tuition, etc., but they also expect that they will have a seat to sit in. I mean, that they will have a seat in the classroom. So I think, everyone has to worry about the implied contracts that are very important for certain groups. Now, in contrast to other stakeholders, I think shareholders have no really explicit right. The only right they have is the right to vote. For a small stockholder, it means nothing. A shareholder is in some way cannot request dividends, he cannot get his money back, so he's kind of completely at the mercy at the management. So it's a very kind of contract is completely based on trust. And I think this is what ethics is all about, making sure that you create trust with stakeholders. And you can do that by respecting those implicit contracts. And I think that if you have basically raised money, you went to the capital markets, with an implicit understanding that people in the capitalist system assume that you maximize shareholder value, then you have an ethical responsibility to do so. Unless if you told people in advance that you're going to behave differently. If in advance you would go public and say, this is a company, we're going to raise money, we're going to spend 10% of our profits, we're going to give it to the poor, and that will be reflected in the share price, then I think it's okay. Or you would attract investors that actually like this. Some people actually may like that money, that you give money to the poor, and therefore they actually you would attract a clientele that likes this type of activity, then it would be okay as well. But what I'm kind of concerned about is that basically people essentially in some way assume that the company cares about them, and then the company afterwards turns around and does things that are against it. I think that's unethical because that amounts to selling overvalued stock to investors.
How do you define maximizing shareholder value? Most people would define it as doing anything within the bounds of the law to maximize the company's profits, but you don't exactly see it that way.
No, I think there's very different between profits and value. I think profits is an accounting-driven thing. So most of the scandals that we talk about, the Enron that often finance is accused of, have to do with accounting manipulations. And we in finance, we focus on cash flow, not accounting, right? That's one thing. Secondly, we are long-term. We take a long-term perspective. In discounted cash flow, you calculate the present value of future expected cash flows from now until infinity. So this is a really long-term concept. This is not maximizing shareholder value, is not maximizing short-term profits or earnings per share. And also, profits do not adjust for risk. We adjust for risk. We think it's important that the riskiness of the profits, the cash flows, have to be discounted with a higher rate. So that is the main difference. And I think that it's true, I must admit, that in the real world, it's true that people use other valuation methods than discounted cash flow. I mean, you have investment bankers use multiples of earnings, etc. And I do agree that this type of methodologies may encourage unethical behavior. If people think that short-term stock prices are driven by multiples, and therefore all what you have to do is to manipulate earnings per share, that may encourage accounting fraud and manipulation, etc. But that is not what we teach in business schools. We do not teach multiple valuation. We teach DCF. We also accept that the stock price does not always is equal to the value of the firm. Stocks can be overvalued, like in the internet bubble or whatever, undervalued. And therefore, maximizing shareholder value is not manipulating the stock through accounting fraud to maximize the current stock price so that you can exercise your stock options. I mean, this is not what we do. So I think the confusion has to do with what in some of the textbooks in finance teach about shareholder value, and what some practitioners actually use different methods. And this I think where I think we have the misconception about what goes on in classrooms.
So one could not say that the Enron case, for example, isn't just taking shareholder value maximization to the nth degree?
I mean, every shareholder in Enron lost their money, so it's difficult to argue that this is a case of shareholder value maximization, right? I mean, basically that's one thing. Secondly, it's the case that if you think about the value of Enron at the time when decisions were taken, and the value was probably known by the management, was very different from what the market was thinking, right? So the true value of the firm was not equal to the market price. And what went on here was in the case of accounting fraud, trying to manipulate stock prices. Is nothing to do with maximizing shareholder value. I mean, that's a different type of...
Okay, you go a step further because you say some well-intended corporate social responsibility initiatives are unethical. Under what circumstances could they be considered unethical?
Well, if they go at the expense of shareholder value. If you raise money and you say there's an implicit contract that you're going to care about shareholder value, and then afterwards you do things that destroy them, I think you basically have cheated the investors. You basically have promised them certain things, that you care about them, and then you care about other things. So the fundamental question for me is if CSR really something that is a marketing tool because some of your customers and other people are sensitive towards those social issues, and therefore it actually, the loss to the expenses that you create are compensated by higher revenues from your customers, then there is no problem. Then it's just a simple, another way to create shareholder value. It's a marketing system tool, basically. On the other hand, if the management actually wants to do good with shareholders' money at the expense of them, I mean, that's something where I object. And I think there's an interesting case going on now with the Rockefeller family is fighting Exxon management, because Exxon does not wants to stick to the core business of oil and gas and not in renewable energies, basically, right? Now, the interesting issue here, typically when shareholders complain about managerial strategies because the stock has gone down. Now here, Exxon is an all-time high, so this company creates a lot of shareholder value for the business. So now the Rockefeller family wants to change the policy. Now I cannot get rid of the impression that this is not driven by concern for shareholder value, it's driven for concern that some people out there think that Exxon should go and be concerned about global warming and become socially responsible and therefore destroy value in the process. I mean, this is what I would object against. I think that Exxon management has an ethical responsibility towards the shareholders that they do the best thing what they think is right for shareholder value.
If I were to sum up, basically your main argument against corporate social responsibility has to do with the way you view value creation and the way the corporate social responsibility people view value creation. Because many of the CSR people will say that by acting socially responsibly, companies will create more value in the longer term than if they don't act socially responsibly. So both CSR and yourself are both talking about maximizing shareholder value, but just going about it in different ways.
Yeah, sure. If that's the case, then I have nothing against it. But then it's up to them to prove that this is indeed exactly the case. That if a company like Exxon is create more value than anybody else in the world, should basically even create more value by changing the policy to a different strategy, then the burden of proof is on them. I think the burden of proof is easier if a company has gone down the drain and did something bad and is really underperforming. I would be less surprised to see people at BP that has underperformed the market to complain about the strategy than basically Exxon, right? So I think it's the burden of proof.
You think that managers should be less timid, quote, in defending the pursuit of shareholder value as a policy that maximizes social welfare. Can you elaborate on this?
Yeah, because I think that when people here want to maximize shareholder value, they think that they care about the shareholders, don't care about the other people. This is the impression that you get. But shareholder value is a kind of residual claim. If you think about shareholder value is calculated off the revenues that you get from selling to customers, the salaries you pay to workers, the taxes that you pay, the interest. In some way, the shareholders are like, the company is like a big pizza, and at the end of the line, they get the leftover piece, that the residual piece is theirs. Now, if they get paid in some way, then everyone else up front is being paid. So everyone else is being compensated. And to that extent, shareholder value is in some way incorporates the interest of everybody. But we do not balance. I think this is where the big conflict is between the stakeholder people that want to balance things. We do not balance things because I don't think there's anything to balance. I mean, if you give less to Paul and more to Mary, then Paul will react. I mean, you cannot assume that there's a competitive market out there for capital and labor, and in the long run, the returns on capital will be a competitive rate of return, and if you deviate from that, you will go out of business. So you cannot behave like a politician. I think what the stakeholder value people seem to think that the company is like in isolation, and you can take away some money from people here and some there and kind of balance these things. But there is a market out there, and I think you cannot just go and ignore the market. You cannot manage a company the way a politician manages a country. A politician, he takes away money from Mary, gives it to Paul, and Mary cannot do anything except next 4 years from now vote against the politician. But this is the difference between
Let's elaborate on that for just 1 second. Basically, you're saying is that there's no conflict of interest between the shareholders' interests and the other stakeholders, but many people feel this is counterintuitive because many people feel that the residual profit that goes to the shareholder is seeking to be maximized, and therefore if you're giving less to the employees, less to clients, you can give more to shareholders. Therefore, mechanically, their interests aren't aligned and are in conflict. And it does seem intuitively to make sense.
But that's the fixed buy assumption, right? That if someone gets more, then the other one gets less. But this is not necessarily the case. I mean, it's not the case that everything is a redistribution issue. I mean, clearly, the workers obviously, the workers get a compensation that has to be competitive. I mean, that's what you have to pay. You have to pay competitive salaries. The shareholders sometimes may seem like they get abnormal profits. Let's say an oil company today. It seems like shareholders make a lot of money. But that is because shareholders are a more risky claim. In some way, the expected rate of return on oil investment may still be a normal profit in the long run, although in the short run, you see abnormal profits, but there will be cases will be abnormal losses. And I think you should understand that the riskiness of equity means that there will be periods when profits look abnormal high and sometimes abnormally low. But that doesn't mean every time that they're high, that then you should start distributing to the workers, because then you pay the workers a higher than competitive salary. I think this is not, while as a result, shareholders will earn a lower than the competitive rate of return in the long run. I think this is the issue here. You should, there is a market for factors of production, and people have to pay competitive compensation. That's fine. But if you start redistributing above or below competitive compensation, I think there's no economic argument that you can make for that. Then you start acting like a politician, distributing wealth among your friends, which is not exactly what, which I think is not what the shareholders expected when they bought your shares. I mean, if you tell me in advance that whenever I make a lot of profits, I'm going to pay a big bonus to the workers, you should tell me that in advance so that I know that my returns are going to be much lower than expected to be the case otherwise.
Last question. You talk about relations between financing and ethics professors as being antagonistic on all of these subjects. Why do you think that by focusing on the need to respect implicit contracts that these relations will become less antagonistic?
Well, I think that to some extent, I think first of all, the less antagonism will come from the fact that we clarify some issues. At least when I talk to some ethics professors, that I think they seem to be following, I would say, the view of shareholder value of many of the journalists and people that have not taken finance classes and don't know what goes on in finance classes. And by explaining to them that it's not the same thing as maximizing the short-term share price and earnings per share, which most people think it is, that already has one source of the confusion has been cleared up. Like, the Enron business has nothing to do with shareholder value maximization. Now, whether they like the implicit contract argument, that's of course a debate. For me, from the point of view, I think it's also a value, the value that you attach to implicit contracts, but it's a value that I think is necessary for the survival of the corporation. It's not a value that says I'm a good person. I'm not going to, as I said, I'm not going to get bonus points in heaven by saying that. But I think is for a corporation to survive, you have to start really concerned about implicit contracts, and I think that's an ethical responsibility to actually, ethics is about, I think, in business should be basically to create trust so that people trust you. If we see today, the financial sector look at what happens today in the financial sector. I mean, we see that the big losers are the stockholders of the company, of the banks, massive losses. The winners are bankers that got fees for arranging deals, CEOs that got paid bonuses based on earnings per share, and then some people got housing that they shouldn't deserve, that they got into. I mean, so there you see again, the reason why the financial sector is such a problem is because people have lost trust that actually these companies are not run for shareholder value, that they are run for creating bonuses for the bankers. If that's the case, then of course you're in deep trouble, because then the whole model kind of breaks down. I mean, this is why, it's kind of interesting that the best performing bank is Goldman Sachs, which is a bank that is mostly controlled by, the management themselves, which is a different story. So I think this is why I think, respecting this contract, I think is crucial for the survival of the capitalist system. If you believe in a market in which there are many shareholders, dispersed ownership, developed capital markets, then you need this type of respect for contracts, and I think that that's maybe a value that is different from other values that people have, but I think it's worth considering.
Theo Vermaelen, the Schroders Chaired Professor of Asset Management and International Finance at INSEAD. Thank you very much.